From Pennsylvania, Mr. Rothfus, for 5 minutes.
Thank you, Mr. Chairman. Welcome, Chair. I want to talk briefly about custody banks, which you know follow a different business model from other financial institutions. Custodians do not make consumer loans or engage in investment banking, and for these reasons pose relatively little credit risk. I understand that custody banks, whose customers would include, for example, pension funds with millions of beneficiaries, are finding it increasingly difficult to provide their core custody services, especially accepting large cash deposits. And this could worsen under a period of stress. One of the main reasons for this appears to be recent regulatory reforms, such as the supplementary leverage ratio, known as SLR. Custody banks typically place cash received on deposit with the Federal Reserve. This is cash that comes from pension funds, endowments, municipalities, and other clients. However, the Federal Reserve supplementary leverage ratio does not recognize the essentially riskless nature of Fed deposits or the necessity of these placements by custodians. This may cause the leading custody banks to reject customer cash deposit. My question is the Federal Reserve aware of the impact that this may be having on custody banks? And if so, what do you propose to do about it?
Well, this is something that was considered what is the appropriate treatment of central bank deposits when the supplementary leverage ratio was adopted. And a decision was made at the time that the leverage ratio is not our main capital tool, but a backup capital tool that is intended to, in a crude kind of way, base capital requirements on the overall size of a firm's balance sheet, and that for that reason it should be included. We have more recently put in place capital surcharges that apply to the 8 largest U.S. banking organizations, including 2 custody banks. And it's likely that once those are in place, that they will become the binding capital requirement. But
well, I would encourage you to take a look at that because it's an issue for the bank.
You've heard of the problem, and I will.
As you know, Chair Yellen, the Bank of Japan recently announced that it would implement a negative interest rate policy in an effort to increase spending and investment and spur growth. The decision follows close on the heels of the European Central Bank's announcement that it would also launch additional monetary stimulus in March. And economists have predicted that Sweden, Denmark, Norway, Canada, Australia, and China may follow suit. In a recent editorial in the Wall Street Journal, William Pohl, the former president of the Federal Reserve Bank of St. Louis, argued that these sorts of monetary policy gimmicks will not create their intended effects, and instead they will only serve to divert attention from the actual structural problems that have plagued growth in the U.S. and around the world over the last decades, namely regulatory burdens and tax policies that serve to constrain business investment and long-term growth. What do you say in response to Mr. Pohl?
Well, I agree that there are structural factors that have restrained U.S. growth and also been responsible for rising inequality in the labor market. And it's important to take steps to address those problems. They're steps that are in the domain of Congress. But it's important for the Fed to try to achieve its mandate of having, ensuring a state of the labor market where people who want to work are able to find jobs, where there are a sufficient number of them, and given the stress situations that exist in Europe, where there remains very high unemployment, and in Japan, where inflation has, for well over a decade, undershot their inflation objective. It's a tool that has proven useful to them.
I want to talk a little bit. You testified earlier over the past number of years, the Fed kept federal funds rate at exceptionally low levels. And with that, you testified that even with this, quote, exceptional, close quote, strategy, the economy achieved only 2% growth. And you added, quote, economy is being held back by headwinds. I'm wondering if any of these headwinds are man-made, or to borrow a phrase, anthropogenic here in the United States. And I could identify some. The Affordable Care Act, a Wall Street reform bill that missed the mark, frankly, EPA regulations, and these headwinds have hit folks in my district, like a mom who now has to pay $400 for allergy medicine for her kid when she used to pay 10, or the coal miner I talked to last week who's taking care of a 5-year-old, a 3-year-old, and 1-year-old won't be able to pay for his mortgage. And I just wonder, when the economic history of this decade is written, I think I say that the Fed tried to do with monetary policy what should have been done with fiscal policy.
Well, I think it's also important for Congress to address structural factors that are holding down growth.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Cleaver.